Hey, good morning, everybody. Thank you for coming. So today, our special guest speaker is Sarah Menchaca from Southern California Funding, and she's going to give us a presentation on the loan process.
All right, thanks, Carlos. Hi, everyone. As Carlos mentioned, my name is Sarah Menchaca with Southern California Funding. I've been in the business for over 20 years. Um, and this is probably, I think, the fourth time I've been given this class. Is that correct, Carlos?
About, yeah.
So, yeah. For some of you, this might be new, and maybe this might be a refresher for some people who have joined in the past before. But I'll go through all my slides here, and I welcome any questions during the process of the presentation. So the idea of this course is really just to get you guys familiar with the loan process and give you guys some basic knowledge of what takes place on the lending side. In no means is this for you guys to be experts on this process,
Mhm.
but it is always good to have a general idea of how the loan process takes place. So here's just kind of a list of what takes place. So before you actually get a buyer and start looking at homes, you will have a buyer that will go through the pre-qualification process and the pre-approval process. And a lot of times those are actually done on the same day. The difference between a pre-qualification and a pre-approval is really the verification of everything that's being said by the buyer. So on a pre-qualification, it's just usually about a 10-minute conversation with a borrower. The loan officer is getting general knowledge of the buyer. So it would be an estimation of their credit score, an estimation of what their income is, what they're going to put for down payment, what their current debts are. And based on that information, a loan officer would be able to tell them what they would typically be able to qualify for. Now, because sometimes borrowers are really good about what their financial information is, other borrowers, they may not really, they kind of know, but they don't know. And what I mean by that is it could be someone who is a self-employed borrower who, knows what their income is, but based off of, what they're writing off on their tax returns, their income might be much less. A borrower might say that they make $200,000 a year, but in that $200,000 a year, there's overtime income, bonus income, commission income, and that's all income that a lender will look at differently. So I always recommend that every buyer should go through the pre-approval process. The pre-approval process is is really letting your sellers know, it's letting the agents know that they have gone through everything to get pre-approved, meaning that they have had their credit run and all of their income and asset documentation has been reviewed. And that's important because on a pre-qualification, you're just going off of what they say. And so on a pre-approval, everything is verified. And why that's important is you don't want to have your offer accepted. You're 2 weeks into the loan process, and then you find out that there's a problem with the buyer's income or assets, because now you're putting everything in jeopardy. You're putting the buyer's escrow deposit in jeopardy. And then, there's probably money that they spent, on home inspection reports, termite inspections, and, probably the appraisal. So I always, advise the agents that I work with to make sure that they advise their clients that the pre-approval process is very important. So anyway, so then we get the offer accepted. The credit package is submitted to the lender. So that is, everything that we collected in the pre-approval process, along with everything that has to do with the property. So the purchase contract, the prelim, escrow title, etc. From there, we've received the conditional loan approval, the final loan approval, the loan doc signing, and the funding and wiring and reporting happens. So each slide will kind of go through it step by step. So again, talking about the pre-qualification, I spent a little time talking about that. Um, so this is just, based again on the verbal information received from the borrower. At this time, we will also let them know what type of loan they can qualify for. So there's conventional financing, which is typically backed by Fannie Mae or Freddie Mac. There's FHA and VA financing. which are government-backed loans, and then there's alternative financing. And alternative financing has become quite popular in the last couple years, but this would be for your borrowers that are self-employed and perhaps their tax returns don't show enough income. So you'll hear, someone getting a bank statement loan, a CPA loan, um, qualifying off of their 1099s. So basically, it's creative financing for a self-employed borrower to help them qualify for more than what their tax returns would show. Additionally, alternative financing could be for your investor. So you'll hear the term DSCR, and basically it's a debt service loan. The property type does have to be investment. So again, it has to be for your investor. And basically what the lender is looking at is they want to see that the rents received on the property are going to cover the total mortgage payment. And by total mortgage payment, I am talking about your principal and interest, your monthly property taxes, monthly homeowners insurance, and if there's any monthly HOA dues. The rents must cover the total mortgage payment. And if it does, then basically the loan is qualified. We don't have to look at any other income documentation for your borrower. So it's a perfect loan for an investor who wants to expand their portfolio.
So Sarah, what if the buyer plans on living in one of the units? What happens then?
Um, it usually does not. It doesn't work out that way. It has to be a true investment.
Okay.
Yeah. And then just real quick, when we talk about over here, like of who to use, the different types of lenders that your buyers will be using. A retail lender will be someone like Bank of America, Chase, a credit union. A correspondent lender is similar to a wholesale broker, but basically they're using their own warehouse line and they're limited. Both a correspondent lender and a retail lender are going to be limited to whatever products and programs their company is financing. And then a wholesale broker, which is someone like myself, we have access to pretty much any type of loan product out there. We have access to. So the benefits typically of using a wholesale broker is that we have access to more products. A lot of times our guidelines are going to be more broad in the sense that we can go up to like a higher debt to income ratio. And a lot of times we can use limited documentation. So where that helps is, a self-employed borrower, if their tax returns do show income, and let's say, year 2023 was a horrible year 2024 was better. With certain guidelines, we can get away with just using the 1 year's tax return. And then typically for a wholesale broker, our costs tend to be less as well. So then once we get to the pre-approval process, a lot of my agents will ask me like, well, what kind of documentation does my buyer need to have ready for you? So here's a list of documentation that would be needed um, as applicable. So obviously, if someone is a W-2 employee, we're not going to be asking them for their tax returns. Tax returns are only needed if they're self-employed, if they're using retirement income or rental income, if meaning that they own other properties other than their primary residence. Business tax returns are always going to be required if someone owns more than 25% or more of a business. So sometimes it could be, a partnership. They're getting a K1. Sometimes if the K1 is, 10% of the company, we're fine just using the K1. But if they have a 20% ownership in that company, we do have to have their business returns. And so again, this is why the pre-qualification process is just really important. You see all the documentation that we are reviewing and approving upfront before the offer even gets accepted. All right, so once the offer is accepted, this is when the clock has started. And there are certain things that are very time sensitive to the lender in order for us to get the loan closed in time. So a lot of times, I'll get a phone call from an agent who's writing an offer and they want to know, Sarah, when is the soonest we can close? And so going through the whole pre-approval process with the buyer is really important because it does cut down on like a week of what it would take if you were starting right when the offer is accepted. The other documents that we need right away are going to be like your the loan estimate. This comes from the escrow company. We get the escrow and title fees from the escrow officer, and then we prepare our loan estimate. The appraisal should always be ordered within the first few days of the offer being accepted, if not on day one. And then at that time, the lender will take care of submitting the loan. If it's a condo, we also simultaneously will do the condo project approval. And then the closing disclosure is also another important disclosure that needs to be completed by the lender. And this is usually done after the appraisal is in and after the loan approval is in.
Sarah,
So
who needs to notify you, and when should they notify you when the offer is accepted?
when the offer is accepted, I want to know as soon as you guys know. I would like to have, a copy of the purchase contract and the escrow contact information really on day one. It just helps for me to go ahead and reach out to the to the escrow officer and get all the documentation that I need to ensure that we can submit your file in time. And then it just also helps with contacting the buyer and then at that time discussing if we want to lock in their interest rate at this time or not. So, always let us know day one. When I get the credit package ready for submission to the lender, in that package is going to be the loan application, the credit report, all of the income and asset documentation. And then the reason why we want to know, on day one, that it's one that the escrow has been opened and who the contact information is because we want in that credit package, we want to have the purchase contract, the escrow instructions, the title report, and then we want to time ourselves to order the appraisal and the HOA documents if they're needed. A lot of times the title report can be a holdup. So a lot of times we'll just submit the file and then the title report will follow as soon as we get it. After the package is submitted to the lender, it goes in front of an underwriter. And so the underwriter is the eyes for the lending company. And after they review the file, they will issue what's called a conditional loan approval. So a conditional loan approval, what that means is that we will lend to you based on us receiving all these items listed below. So that's why it's really important for us as the lender to make sure that we're getting all of the documentation to the lender when they look at it the first time, especially if it's an escrow that you guys are trying to close quickly. Sometimes I have agents that want to close in 2 weeks, 3 weeks. So we want to make sure that we're doing everything we can on our end to get everything done quickly. So typical conditions that may appear on the loan approval would be a verification of employment. Get the homeowner's insurance policy, the appraisal report, and the condo approval. If at that time the lender has any additional questions regarding the borrower, maybe there's some type of discrepancy with addresses or something that they see on the bank statements, it'll be listed here at this time. When I do my pre-approvals, I try to get all of that information up front and submitted in the credit package. So there's not that many conditions on there that can be concerning. I do want to touch base though on a verification of employment. The verification of employment, the lender has the right to verify employment at any time between the start of the loan all the way up until closing. So I think once in my years of doing this, we did have a borrower who lost their job the day escrow was supposed to close. and they will verify it. And unfortunately, at that time, we weren't able to close the loan because the borrower was no longer employed.
Sarah, what happens
Um,
if the buyer ends up buying a car during this process, or it makes a big purchase that they get financed on?
yes. So that's a great question, Carlos, and it is one that comes up. Sometimes, I have clients who are like, "Well, I'm in a lease, and my lease is going to expire, and I have to get a new one right in the middle of the transaction." Other people are just like, well, I really want to buy furniture, or I really want to buy, something for the house. So always, if you hear that conversation between you and your buyer, please let them talk to the loan officer immediately. A lot of the times, when we qualify your buyer, we're taking all of their debts into consideration, and we're coming up with what's called a debt to income ratio. Certain programs, certain guidelines allow for that debt to income ratio to be at 45%, 50%, 55%. It depends on what type of loan program your buyer is being qualified for. If that new payment pushes them over the edge, that potentially means that they could not qualify for that loan anymore. So for example, if you have a buyer, we're at 50%, max debt to income ratio, and then they have their credit run, they charge a large purchase of financing furniture or car payment. The lender will get that notification, and then they'll ask, what was this inquiry for? We'll have to provide them documentation. If they can't qualify with that payment, then that means the approval is no longer valid. There are some cases where there is room in their debt to income ratio, and it's not going to be, a deal breaker, but we still have to provide documentation to the lender of what the new terms are of that loan. And sometimes that can be time consuming because a borrower might not have that paperwork right away. And if we're trying to close soon, we have to find a way to provide documentation. So the general rule of thumb is once you get that, pre-approval, once you're in escrow or something, do not make any large purchases. And again, that's a conversation that I also have with buyer when we're going through the pre-approval process.
Especially if you remove your loan contingency at that point.
Yes, especially. And you guys might hear more too from the buyer where they're like, "Oh, we're gonna go, to living spaces this weekend and we're gonna buy a bunch of furniture because they're offering 0% financing." It doesn't matter. Once that credit is run, once that financing option is selected and approved to them, we now have to hit them with that payment. Even if the payment's deferred, even if their plan is to just charge it and pay it off, it can still delay your loan process. The other thing I want to talk about is homeowners insurance, especially here in California. And, I'm sure what you guys have seen on the news and just heard through probably your own clients is homeowners insurance can take some time. So I always tell my clients, start shopping around for homeowners insurance the day the escrow opens. If they hear it from you guys as well, that will just help the process, especially if it's a home that's, located near, you know, wild tree, near brush, a big hill. Sometimes getting homeowners insurance can take some time. The other thing too is sometimes homeowners insurance can be more expensive than what your client originally thought it was going to be, especially if they're required to carry two policies. One through someplace like State Farm or AAA, and then now they also have to get fire insurance through the California Fair Plan. So that is something that you would want your buyer to know before we get to the contingency removal process. Okay. And then once we get all the conditions on the loan approval in and sent over to the underwriter, we get what's called our final loan approval. And so at this time, what they're basically telling everyone is that, you guys are clear for docs. Now, this doesn't mean that they go out and buy a new car, new furniture. We're still have to close the loan. But at this point, they have received everything that they need to receive, and now we can draw loan documents. So you always want to try to get this final loan approval at the time when contingencies are going to be removed, or at least have that conversation with the loan officer. Hey, are we good to remove contingencies? I would never actually recommend having your client remove the loan or appraisal contingencies until you've had that conversation with the loan officer.
So do you recommend that the buyer's agent reach out to you before they're gonna remove the loan contingency to see if if they're good to go on your end?
Yes. Because you just want to make sure that everything's final on the loan approval. Okay. And then at that time, once we get the final loan approval, we will be sent to the closing department or the loan doc signing department. Um, when do loan documents get signed? Well, the closing disclosure must be disclosed. So that's something that we had talked about in the beginning. The closing disclosure is basically the list of like the final fees that are associated with the loan. The loan must be locked at this time. The loan amount must be finalized at this time. Um, if there are any credits coming from the agent or from the seller, you do want to let your loan officer know as soon as possible. Um, a lot of the times there will be a credit after the home inspection's done and then the repair request goes out. The seller may not want to take care of all the repairs and is going to issue, a credit for those repairs. If you're getting financing on a loan, the lender will not accept that the credit will go towards repairs. It must go towards closing costs and prepaids. So for when you're negotiating that with the seller, it's okay to go ahead and negotiate, here are all the repairs on the property. The seller says, okay, well, we'll give you X amount of dollars, for those repairs. And then at that time, when it's finalized, you need to let the seller know, okay, now we need to do an addendum or an amendment to state that $10,000 is now going to go towards the closing costs and prepaids. And if that is the case, always let your lender know upfront right away what that closing cost credit is going to be. And the reason why that's important is that we want to make sure that there's enough closing costs and prepaids in the transaction for the seller to cover it. So there's been one case, actually a couple cases where we've gotten close, where the repair cost for termite was going to exceed like over 25,000. And that can be an issue because a lot of times the closing costs and prepaids are not going to exceed 25,000. So at that time, we can look at doing different options. We can buy down the buyer's interest rate. If they're not having impounds, maybe they want to have an impound account, so that way the funds can be used to close to cover that.
Sarah, what's the
Can
most
you still hear me?
what's the
Okay, Carlos, I have the gardener.
sorry,
What's that?
what's the most allowable credit that a lender would allow? Like
So
the high,
it will depend on the loan program that they're qualified for, but typically it can be anywhere between 3 to 9% of the sales price.
and then so another thing that they can do is any unused credits can go towards the reduction of the purchase price.
Yes, you can reduce the purchase price. So sometimes not everyone wants to do that,
Okay.
but that is an option. And then other options can be used, to buy down the interest rate. Um, you know, Sometimes, we have clients that don't want to have an impound account. At that time, it might make sense for them to have an impound account. So if you ever think that you're, close to exceeding the closing costs and prepaids, work with the loan officer and myself, and we'll figure it out. I've always been able to come up with solutions for that. But we want to know that right away. We don't want to know that after loan documents are drawn, and then documents have to be redrawn. So if you're working with me, I will typically always send out a text or an email or a phone call and just say, hey guys, we're ready to draw docs. Please let me know if there's any credits coming. So then once the closing disclosure is issued, the file is assigned to a doc drawer Typically, the doc drawer and the escrow company, they balance the closing statement. The loan documents are sent to the escrow company, and then escrow arranges the signing either with themselves or with a notary. Once the loan documents are signed, they do go back to the lender for a final sign off. So for the lenders that I work with, it's actually really easy. A lot of times we're just sending back, like the note, the deed of trust, and then there's not any funding conditions that need to be signed off on. So typically it's a pretty easy process, but the lender does want to see that the loan documents have been signed. And then there's a certain set of documents that have to go to the title company in order to record. Once we get the okay, sometimes there could be like a review of the final funds to close. A lot of times our lenders, they'll review the funds to close before docs are drawn. But they want to match and make sure that the funds that were actually sent to escrow were funds that were verified before we sent the loan documents. So I'll give you an example of where this could be a problem. Prior to docs, we verified funds to close from Bank of America. They had plenty of money in there. They had enough to close. When the buyer sends in the final funds to escrow, we are expecting to see that it's going to come from Bank of America, and we are expecting to see that the account numbers are going to match the account numbers that were on the bank statements in the file. If a buyer now sends the final funds to close in from, say, Chase, that can delay your escrow because now those funds are no longer verified. And then we do have to have the buyer send in their bank statements, verify that the funds are theirs, verify that the funds are seasoned. So it could potentially delay the closing of a file.
Can you explain that, Sarah, the seasoning of the funds?
Yes. So typically we're always going to look at the last 2 months bank statements. And in the bank statements, we're going to look at the activity that is flowing through the banks. Typically we're going to see, your deposits coming from your employment company, maybe like a few Zelle payments, etc. We're not going to look at any of those miscellaneous payments coming into your account unless they exceed more than 50% of what your base income is. So sometimes it can be like, oh, well, I lent so-and-so money and now they're paying me back. Well, if that money exceeds more than 50% of what your base income is, we do have to provide a letter of explanation, and we do have to source it from the lender. So sometimes it can be gift funds. They're getting money from mom and dad or grandma and grandpa to buy the property. And that's typically okay, but the lender needs to be aware of it. Some programs do have restrictions on what those gift funds are allowed. For example, if you're buying an investment property, gift funds are not allowed. So that could also potentially blow up your loan if the down payment for the investment property is coming from gift funds and they won't have it otherwise. So those are all conversations that we have with a client when we are pre-approving them. But as a loan or as a realtor, it is good to have that information handy.
What if a buyer is bringing funds from out of the country? How long, I guess, before the purchase should the money be here or seasoned?
So it really depends. If it's money that's coming from overseas and we can verify it, meaning that they have the means overseas to provide a bank statement and show the transfer, and we can clearly see that that money was theirs. It's coming from another bank. It's being transferred into their account. If we can document the paper trail, there's typically no issue. Now, if we can't, or if the money is coming from an account that maybe has like another person's name on it, and there's going to be like an issue of sourcing the funds, we want to see that the money's been in there for the last 2 months. So again, we're only going to look at the last 2 months bank statements. Okay. So here I have, lender reserves the right to a gap credit report. So typically, there's two ways that a lender can really be notified if a buyer had their credit run from the beginning of the loan to the end of the loan. A lot of times, a lender has a notification system in place. Once their credit is run, they automatically get a notification, and that's where they'll be notified, hey, so and so ran their credit. Maybe it shows that there was credit given, maybe it shows that there's not. Either which way, that has to be explained. A gap credit report would be, if I ran a credit report for someone in March, that credit report is good for 4 months. We're closing at the end of May. The lender can run a gap credit report, which will cover the days from when I ran the credit report to the days of closing. So that's why it's really important for a borrower to be upfront and honest about their credit and if they're, having their credit run at any time in between then. Once all of these final checks are passed, then the wire is sent to the title company. The title confirms receipt of the funds from the lender and then sets it up for recording. And once we have confirmation of recording, that is when everything is official. So at that time, if your buyer wants to go out and buy, furniture for the home or get their new car, they can do that without any repercussions of the loan not closing. Okay. And so the fall, what I have coming up here is what I kind of call cheat sheets. These are just basically guides to kind of help you, but none of these should be used as guidelines. All of these are subject to change, but these should help you guys understand some loan programs better here. So a lot of times I'll get asked, what are the minimum down payment requirements for loans? This sheet here does give you a general guideline of what the minimum down payments are for, if it's a primary purchase, a second home, an investment property, and then I also have it broken down by the loan type. So VA, FHA, jumbo, high balance conventional, and conventional. But like I said, this is just a general guideline. Sometimes credit scores, credit history can also affect that. If you're doing an alternative loan, which we had talked about, a bank statement loan, a DSCR loan, as a general rule of thumb, always tell your client that minimum down payment on those types of loans will be at least about 25%. Sometimes it's more,
FHA
sometimes
is
it's less.
2.5%.
Say that one more time.
FHA is 2.5%.
3.5%.
Okay. Yeah, because you have 97.5 there.
Oh, okay. Thank you for that typo. Yeah. Okay. And then this has been updated. Actually, this is from a year ago. Right now, the conventional loan balance is 806,500, and a high balance loan is 1,209,750. So those loan balances, they tend to change every year, and they tend to change right around like November is when we get notification of what the new loan balances will be for the following year. They can differ between counties.
Question,
And
Sarah?
then, yeah,
So can you go back to the other slide?
yeah.
So the numbers are for 1 unit, for 2 units, 3 units, 4 units, is that what that is? Then the 1, 2, 3, 4?
Yeah, but this is it does need to be updated. This is what it was for last year, but for a 1 unit property, currently it's 806,500 is what's considered a conventional loan balance. Anything above that, up to a loan amount of 1,209,750 is considered a high balance loan. And then anything above that amount is considered jumbo. The loan amount sizes do vary and increase if the property you're purchasing is a 2-unit, a 3-unit, or a 4-unit property.
Thank you.
And this link that's listed down here, if you go to that, that will take you to the most current information. And it will also allow you to see what the limits are per county. So it is important to remember that per county, the loan limits do change. So here's just a general list of what's considered closing costs and what's considered prepaids. So your closing costs are going to be your general escrow and title fees, lender fees, your points, recording fees, notary fees, miscellaneous fees such as your home warranty, HOA cert, your NHD report, home inspection, etc. Your prepaids, they're called prepaids because they're typically costs that you're paying in advance. So for example, your homeowner's insurance premium, a buyer is going to be required to pay the full 12 months up front through closing. Your prepaid interest, so unlike rent, when you pay rent for say May 1st, you're paying for the full month of May. On a mortgage interest, you're actually paying the interest in the arrears. So for someone who's making their payment on June 1st, they're actually paying for all the interest that was due in May. So when we're closing, there's going to be some type of prepaid interest that the buyer is going to pay through escrow, and it's going to be prorated from the closing date. You're also going to have a proration of the property taxes. So this is going to be the property taxes based off of what the seller is currently paying. And depending on when we close, the credit or charge to the buyer will differ. So for example, if a buyer is closing in March, typically the seller may have already paid the property taxes that were due, January 1st through July 1st. And now the seller or the buyer is going to credit back the seller the property taxes for the months that he is now going to be living in the property. And then at this time, when I have this conversation with the buyers, I always let them know about the supplemental bill that will be coming after closing. And I know that for the agents that there is a disclosure in the CAR forms regarding that supplemental bill. But I always like to, always warn the buyers about it because it can be a surprise to them after the close of escrow. A lot of times they forget about it. But I always touch base on the supplemental property taxes because when we're talking about closing and the way that the fees are generated between the buyer and the seller, it's based off of the seller's tax bill and what they paid for the property. The supplemental bill makes up the difference of what the new buyer has now paid for the property. Now, impounds, an impound account, sometimes referred to also an escrow account, not the same as the escrow company, but the impound account is optional on most loans. And basically what it is, it's your monthly property taxes and your monthly homeowner's insurance. Every month when you pay your mortgage payment, your principal and interest, in addition to that, you're also going to pay a prorated amount that is for your property taxes and for your homeowner's insurance. The lender will take that money, keep it in what's called an escrow or an impound account, and pay the property taxes and pay the homeowner's insurance premium when they are due. But again, it's something that's optional for most loans. There's a few loans where they are required to have it. Typically, if it's a first-time home buyer and you're putting like the 5% down, and your DTI is over 45%, they will require impounds. And then property tax installments, again, depending on when we're closing, there will be some type of prepaids for the property taxes. You heard me mention debt to income ratio in the beginning, and this is something that we do when we're pre-qualifying or pre-approving a borrower. This is just kind of the general ratio that we use that if you're talking to a client and you're and they're asking you like, oh, like, what do you think most lenders will approve, or what are they going to look at when they're calculating my debt to income ratio? This is a good cheat sheet to follow to get that ratio. So your front end ratio is just going to be the total housing expense divided by your income, where the back end ratio is going to be the total housing expense plus all your monthly debt divided by your income. So typically this is the back end ratio is really like what we're looking at. General rule of thumb, people say 43%. When you're working with my lenders, we could push that number a lot of times to 50%, which does help your buyer qualify for more money. And then if you're doing a government loan, a lot of times, we can go up to 55%. Sometimes on a VA loan, we can even push that number higher. Oops. Okay. So a lot of times people are asking me about, what are points versus, buying down an interest rate. So when we talk about points, also sometimes referred to as a discount point, it is a one-time fee that the buyer is paying to lower the interest rate on the loan. So if someone's paying 1 point and the loan amount is $500,000, you're paying an additional $5,000 in closing costs to buy down your rate. And so sometimes, people ask, well, how much does it actually buy down your rate? And that is something that can differ depending on what the market is doing. I will say, generally speaking, paying 1 point can buy down the rate as much as 0.25% to sometimes even 0.5 point. Now, a buy down, this is what's become more popular in the last couple of years, especially as the interest rates are increasing. A buy down is a way for a home buyer to lower their mortgage interest for maybe the first year, 2 years, or 3 years of the property. It's different from an ARM. If someone is buying an ARM, which is an adjustable rate mortgage, you're buying down that interest, the rate is lower for a fixed period of time, and then it adjusts. When you're doing a buy down, the interest rate could still be, the note rate would show as 7%, but then maybe you're buying down that interest rate by 1 point for the first year, or maybe even 2 points or 3 points. But we'll get into that a little bit later here. But it's very different or it's important to understand the difference of paying a point versus a buy down. So here's just kind of a cheat sheet regarding the buy down. And typically the buy down does need to be paid by the seller. There are times where the lender can charge it as points, but it does get kind of expensive for the borrower to do that. But generally speaking, the way that it's done is with a seller concession or a seller credit. So how that works is like, if the interest rate is say 7%, and you guys have agreed that the buyer or that the seller is going to buy down the interest rate for 1 year at 6%. How we calculate out how much the seller is going to pay is we take the difference in the mortgage payment of what the mortgage payment would be at 7% versus what it would be at 6%. We take that monthly difference, multiply it by 12, and then that is the amount that the seller will pay for the temporary buy down. So in essence, your buyer is going to pay for the mortgage for the first year at a rate of say 6% versus 7%. But the difference in that payment is actually going to be paid by the seller. So the lender's still getting paid the same amount. It's just beneficial to your borrower because they're going to have a lower payment in the beginning of their loan. So here's just examples of what type of buy downs are available. A 3-2 buy down, 2-1, 1-1, and a 1-0. It explains here on to you how each buy down is allocated to the loan. And here's an example of how a buy down would work. So in this example, the purchase price is $800,000. We have a loan amount of $500,000, and we have the interest rate here at 7%. So this 7% interest rate is in fact the note rate for your buyer. We're going to look at an example of what it would take for a 3-to-1 buy down. So what that means is that year one, you're buying down the rate by 3%. So they're going to be paying 4%. Okay. The annual savings between paying a 7% interest rate versus a 4% interest rate is $11,273.16. Okay. On year two, the interest rate goes up. We're now at 5%. And then at year three, the interest rate is 6%. And then years 4 through 30, the interest rate goes back up to 7%. Now, what you guys need to look at is what the buy down cost is. And so the concession required would mean that if you wanted your buyer to get a 3-to-1 buy down, you're now asking the seller to pay concession of $22,927. A lot of times that's not going to happen. A lot of times we're going to be looking at, maybe there's $10,000 to work with, $15,000 to work with, and, they might be qualifying for like a 1 or 2 year buy down. But this is just an example to show you how this can be beneficial to your buyer in the sense that they are going to be paying less. So for example, on year three, instead of paying the $3,326, they're paying $2,997, and they're going to get a significant monthly savings that's going to help them, get over that jump of paying a big mortgage right away. Does anyone have any questions on that? Because I know this one comes up a lot.
Yeah, can someone refinance within this time period if the rates happen to drop more than what this is? Just if.
Yes, you can refinance.
Here's another question.
And what's the minimum down payment to do a buy down program?
Well, there really is no minimum down payment. It just there's certain programs. So if I go back to this sheet here, it tells you the minimum down payment for these certain programs. The buy down is just allowed on most types of loans. So if we look at this sheet here, it does have to be a purchase. It does have to be a conventional fixed or an ARM, a primary or second home. So buy down is not allowed on an investment property. So these are the certain programs that a buy down would be allowed on. And then additionally, when you guys are at the offer process, the negotiation process, you have a buyer who's asking you about a buy down. You want to go ahead and try to negotiate this with a seller. You're not exactly sure what the interest rates are for the program that they're approved for, how much that would be needed for a buy down. Have that conversation with me before you write up the offer, and I can let you know how much the seller should be expected to pay. And then are just some further examples of what, a 1 year buy down would be, a 1-1 buy down, a 2-1 buy down. So on this loan amount of 500,000 kind of gives you a general consensus of what close to what the concession amount should be that you guys are asking for. Like I said, if you have a specific scenario, a certain offer that you want to do this on, let me know. We'll go ahead and run the numbers, and I'll tell you how much the concession should be. And then that brings me to the end of the presentation, and I can open it up for questions.
Anybody have questions? No. Wow, you're just so thorough.
Sonia, did you have a question?
No, thank you though.
Oh.
Well, that was great.
All right, thank you, Harriet.
And Is this the same presentation you emailed me?
It is.
Okay, is it okay if I email this to them as a PDF?
Of
Along with
course.
the, okay, great,
Thank
Yeah,
you.
and then I'll go ahead and send out an updated loan amount sheet too, just so that they have that for reference.
okay. Well, Sarah, thank you very much. It was a great presentation.
Thank
Of
you.
course.
Thank you, Sarah.
If anyone has like a specific scenario that you want to reach out to me directly, feel free to give me a call. My information is on the front of this presentation here. This is my cell phone number. So I'm always reached at this number.
We'll give them a minute here to write your number down.
Yeah, that was a great presentation. Thank you.
Oh, you're welcome, Sonia.
Okay. Thank you, Sarah.
Thank you, Carlos.
All right,
Take
see you
care.
guys.
Bye.
Bye-bye.